Welcome back and thank you for staying with us. Now, South Africans will continue to pay through the nose. This follows the decision by the Reserve Bank to hike interest rates by 25 basis points. The latest rate hike is the 8th consecutive increase of the repo rate since November 2021. It's 375 basis points if you work it out since then. What does the new rate mean for those with a car repayment and bond? Well, we're joined by KPMG's economist, Frank Blackmore. Thank you, Mr. Blackmore, for joining us here on eNCA. 375 basis points in terms of the repo rate since November 2021. It looks quite bleak. A lot of South Africans feeling very despondent, even though it could have been worse because there were 2 out of the 5 who wanted the 50 basis point. But do you have any positive news for us? Are we going to get to a point this year, at least, where it stops increasing?
Yes, I think so. I think the positive news started yesterday already with a reduction in the size of the increases in the interest rate. And the Reserve Bank did that because we've seen the trend in inflation starting to come down from the highs in July of 7.8% to what we saw in December, which was 7.2%. The problem is, of course, that inflation remains well above the midpoint of the 3 to 6% target used by the Reserve Bank to control inflation. But it is slowing down, and so we can expect perhaps another 25 basis point movement or 2, depending on what happens to inflation over the time between now and the next meeting in March.
What would you advise for people, who have loans such as bonds or even car repayment loans? Would you say that they should try and fix their loans, or should they keep it at that varying loan?
I think at this point we are close to probably the top point of the interest rate cycle, and therefore if you can stomach just an additional marginal increase, I don't think it's wise to fix the loans, because the problem with going into the market to fix loans, you always will pay a premium. It's not as if one can fix it at the current rate. Because there is uncertainty in future, the bank also has to take care of that uncertainty, and therefore it's not always in your interest to fix bonds at this point.
And I mean, there's something I heard from an economist, I think from SIF, if I'm not mistaken, suggesting that it would be better right now to rent a home than to buy a home. And many South Africans, of course, understand that buying would be better because at least you're paying towards something that you'll own at the end of the day, whereas if you're renting, you're paying someone else's bond. So what do you think is better? If someone is looking at buying a home right now, should they rather stick to renting for now?
I think perhaps over the short term, it is a more prudent option. And the reason is just you're coming in at the top of the interest rate cycle. The term period over which you take a home loan is a long term, and we'll see many increases in interest rates as well as decrease in rates. But if you don't have the current income now to come into the market, I think it would be more prudent to perhaps look at the rental option, but also obviously be advised that in future, in the next 5 or 10 years, similar events could possibly happen, and you would have had to, if you do take out a home loan, you will have to sort of stomach these type of interest rates now and then. This isn't a long-term sustainable level, and we know even the governor mentioned that yesterday. But what he wants to do is reduce inflation to a more sustainable level at around that 4.5%. And once we get closer to that point, we'll see these interest rates coming down. So this is not forever; it's a temporary process, and one has to look at what your budget can manage before making those decisions.
But would you agree with those who say that load shedding is also inflationary?
Yes, of course. Load shedding increases the cost of business. It decreases the competitiveness of South African businesses. And all that sort of the unproductivity caused through the load shedding or the additional costs obviously makes us less productive on an international stage and adds to costs. And of course, it's those costs that are driving a portion of the inflation, at least directly as well as indirectly. Directly through these increases we get in order to subsidize the income's operations. but indirectly through all the other avenues in which load shedding costs you either time or additional money in order to get around whatever the implications are of that load shedding.
And of course, the Reserve Bank is supposed to sort of balance out what's happening, whether it's our own economy in South Africa or external issues like what's happening in the international world, right? And some of this, some economists would say, is not necessarily all South Africa's fault, because early last year we did see the invasion of Russia on Ukraine, and oil prices, etc., were then affected by that. Do you agree with that, or do you think, President Cyril Ramaphosa and his executive have also failed us to some degree?
Yeah, I definitely think the main causes of inflation were initially the COVID-19 and the disruption of, shipping routes globally and transport routes. And this was obviously augmented by what happened, the invasion of Ukraine by Russia, through both the fuel as well as food markets globally. And we're still sitting with those price increases, but we haven't done ourselves any favors either in terms of becoming more productive, in terms of cultivating more growth, in terms of investing in the capital of the sort of capex base of their country, things like ports, rail, waterways, transport facilities, even to a large degree quality of education, healthcare, etc. All of those type of expenditures would contribute to a more productive society and help to keep costs low. And of course, we haven't done that over the last years.
Mr. Blackmore, I want to go back to the point that you and I were speaking about just before this, which is load shedding. You said that, this is something that happens all the time. Inflation does sometimes go up, repo rate does sometimes go up or increase, and then it comes down again. The trend changes all the time.
Sure.
Are you still positive that we'll get to a point where it at least stays the same or starts to go down again at some point this year? Or will the continuation of load shedding hamper that drastically?
Yes, no, I'm definitely positive that inflation is coming down. Remember that invasion of the Ukraine happened in the first quarter of last year. And so the main price increases happened over that first quarter, second quarter of last year. So if we look at the increases currently, they might not reflect a large increase from this period last year. Okay. But as we get more to the middle of the year, we will definitely see decreases in inflation. And these can be quite dramatic decreases in inflation, because we know that, even the prices of the underlying commodities in some degrees have come down. If we take oil as an example, that went up from around 75 all the way to 125, and now is sitting around 80. So even if we compare the 80s to the 120s, that's a big reduction in the price of oil. There's still an increase in prices, but at a much slower rate than we were seeing last year. And that means inflation, the rate at which prices are increasing, will also come down this year towards the middle. And we'll see by the end of this year, we could be close to sort of 5% in terms of that inflation, and the general forecast in the markets is for around 5.5 in that type of zone, which is a big decrease from the current 7.2%.